My goal in this conversation is to get you thinking strategically in how you make your business more profitable, how you pull more money out of the business, stockpile it. So when you go to sell your company, you get maximum value. If you get maximum value and you've accumulated more money, you're bulletproof.
Each financial decision is not in a silo by itself. It has to be looked at and how it relates to something else in your plan. And most people are not looking at the big picture.
This is John Smallwood back on Money Isn't. You know what money is, but do you really know what money isn't? In this podcast, we are going to explore today how to make your business more profitable. So if you're not interested in making your business more profitable and you don't want to make your business more valuable, then you should stop watching this. You should literally stop watching this right now because this does not apply to you, okay? But if you have an open mind and you want to spend the next 25, 30 minutes exploring potential ways to maximize the value of your business, you should take some notes. My belief is this: we all have a game that's in motion. You have a business, it's a chess game, whatever the heck you want to call it. The game is in motion, and every single day you are getting up and repeating the core actions of your business. And it's in the business where we get trapped. It's on the business when I can step up and work on the business and look at the business from a higher level. I can begin to see patterns. I can begin to see things that could potentially change my outcome. But if I'm constantly inside the business, I can't see the big picture, okay? So one of the things that I think is really, really important is I work with a lot of business owners. I see a lot of people, and there's a large degree of people that don't really know how their P&L really works. And everybody says to me, I wish I could do like a master's course on this thing. And I'm not going to say that this is a master's course on P&L profitability because we all are learning constantly. But for 35 years, I've been running my own business. So I kind of have a good indication of the metrics that move the needle, okay? So I want to frame a conversation here from the perspective of, on my screen, you see big company, and this is a 1120S. So it's an S corporation. You can have an LLC that's taxed like a partnership. You can have an LLC that's taxed like an S corp. You can have a sole proprietorship. You can have a C corp. The metrics are going to be the same, the way you're going to approach what I'm about to show you, okay? And when you look at this, there's certain ways that you want to think about your profitability, okay? And working with many, many people over the last 35 years in different aspects, even if you work for a company and you don't control the profit and loss statement, you directly impact the profit and loss of the company that you work for. And when you have an ownership mentality in the company and you're adding value and you can demonstrate visually, you can demonstrate with numbers, you can demonstrate I am working on behalf of the company and providing value, you have unlimited opportunity. And I want everybody to be thinking that way when you're surrounding yourself with a team. You know, Dan Sullivan, strategic coach, you may or may not know him. Ben Hardy wrote a bunch of his books. There's one that's called 10X is easier than 2 times. There's one that's called Who Not How. They are absolutely fantastic books because they're about getting on the big picture and working on the business as opposed to being in the business, right? And their thing is about surrounding yourself with the best possible team so you can focus on the things that you do best that drive the needle in your business. Often we're stuck in very menial tasks and we think we're busy and we got busy ass work going on, but in that busy ass work, we're destroying our profitability because you're taking a business owner and you're allocating them to not a menial task because it's important, but it's a task that can be given to somebody that absolutely loves what they're doing and they're going to spend 40 hours a week in love. I would suspect you're thinking of something right now that you worked on for the last 5 days. And this is where you lose sight of your business. This is where you begin to hate your business, right? Because you're trapped in the business. And the idea is, as an entrepreneur, as a business owner, you've actually designed everything that you have, right? And in that design, you have created something that you want, but now you're on this treadmill. I hear this conversation all the time. I'm on the treadmill. I'm tired. I'm bored. I got to sell it. I got to get my life back. None of those are the right choices, okay? I mean, maybe it's time to sell the company. I'm not going to say you don't sell, right? But for many people, they sell at the wrong time when the company's not as profitable as it could be because they're tired. And when you get people on your team, the right who know how to get shit done, you can get a lot more shit done and get a lot more profitable. And that's what we're going to dive in here today. So enough of the bullshit. Let's just dive in and let's talk about this, right? So big company, LLC, has gross receipts of $13 million, has cost of goods of $6 million. So it has a gross profit of about $8 million. So I'm just going to walk through the numbers really, really quick. The owner pays himself $600,000 in base salary. There are salaries and wages in the company for $2.5 million. They have repairs and maintenance and other related things of $120,000. They have rents for $420,000. They have depreciation of $100,000. They have advertising of $300,000, pension and profit sharing plan contributions, et cetera, and employee benefit, pension and profit sharing contributions of $200,000. Employee benefit programs, $1.2 million. Other deductions, $560,000. Total deductions, $6 million. Net income, $2 million. So compensation says that is $2.6 million. So I'm a big fan of looking at this and saying, okay, if this is the business and I'm presenting the business to somebody to buy it, what is that worth, right? So you basically take this and you say, I've got that SIC code, my industry, and I'm just happen to be using a pharmaceutical and medicine manufacturing. Who knows what the business is? Each SIC code is going to have a different valuation. This one, based on those metrics, I put the same metrics into this where went the wrong way. The same metrics, 13 million with the 2 million with the whole thing, it's worth about $14 million, right? So when you look at this, that might actually be really compelling to you. Like, I'm going to sell this and get out for the $14 million because it's $14 million. And $14 million, last I checked, is still a ton of money. Now, $14 million, if I make $2.6 million and I sell a company for $10 million and I haven't saved any other money, I don't have any other assets, because that happens to a lot of business owners because all their money's getting sucked back into the business to make it happen. I get close to 10 million net, close, conceptually. 4% distribution, which is what everybody says is the distribution rate, is 400,000. I was making 2.6. 400,000, 2.6, 400,000. I can't do it. So part of what you want to do is you want to get as much money out of the business along the way and accumulate as much money as you can, but that's a whole separate conversation, okay? What I want to do is, how do I make this business more profitable, okay? And working with a lot of companies, one of the things that you want to understand is, how did you get to the $13 million in sales? What are you selling? Is it $10 products? Is it $1,000 products? Is it $500,000 contracts? It's different for everybody, right? But what you want to look at is, if I'm looking at this and saying, let me take the $13 million for a second and just say we did 5,000 transactions during the course of the year, and that was 200, did I do that right? 13, that is wrong. Let's take that out. That's 13 million divided by, what'd I say, 5,000 transactions? 5,000 transactions. It's $2,600 average transaction, average fulfillment. Could be anything, okay? Now, here's what I want you to step back and look at. I want you to look at the big picture. And I've had this experience in numerous ways where, okay, our average ticket price is $2,600. We did 5,000 transactions. Do the math for your own business, okay? But now what you want to understand is, have I raised my prices? Have I raised my prices? And I got to tell you, there's a whole bunch of businesses that I've dealt with in the last 5 years that had not raised their prices in 4 or 5 years. because they're afraid that clients aren't going to fulfill it, meaning they're going to drop off. So what I want to look at here is if I said, if I'm going to take this and I'm going to raise my prices by 5%, my average ticket is now $27.30 multiplied by the 5,000. Very simple. It's $650,000 more gross. It's $13,650,000. I take one action of 5% increase, and it drops $650,000 to the bottom line. If I'm getting a 7x multiple to get to the 14 million, that's 600,000. Just make it simple, 7 times multiple, right? It's another 1.4 million of valuation. Actually, it's more than that, right? So 650 times 7 is 4.5 million. Simple math can't do it. Okay. This is all done on the fly, by the way. Okay. There's no prep on this thing. So it's a $4.5 million. So now you're selling your company for 20 million. That's a little bit of a different story. We're getting the income, the net after-tax income up. Now, the next question I want to ask you is the frequency in which you buy. How often do your people buy? Do you have them on a subscription model? Do you have them on a regular refillment, or you have to call them to get them to refill? So I've done this with a lot of different people. Now, some you have to do, it's consistent. There's you got to do a contract, you're doing a project, you got to renew the project. Like that's a different thing, right? But if you're, doing 5,000 orders and your team has to call everybody to renew them and they just keep renewing, let's say you're, supplying, to a spa, some product. Well, how many times they need to fulfill that thing during the year. And if you get them to get on an auto refill and you take the frequency up you just increase it by 10% or 5%, right? So your 5,000 units times 1.05, because they bought a little, so now you got 5,250 in the year. That extra 250 that you just did times the 2750, those extra pieces is another gross of 687,000. Now there is cost of goods on that, so you have to take out your cost of goods. But now you maybe have $1 million between the two moves of additional, which is $7 million on the bottom line, right? So this is a chess game. This is magic. This is not magic. It's literally manipulating numbers to see what is the frequency. We had a client a few years ago where we were doing this and they were really afraid to push through a 5%, but their cost of goods were going up by 5 to 8%. And they weren't passing any of that on to their clients. And I said, well, let's do it in 2 stages. Let's do 2.5 this month. And 6 months from now, do another 2.5. And what was interesting, sales went up on both of those cases. And people bought actually more because they're like, oh, prices are going to go up. I'm going to buy more now. That phenomenon is pretty interesting. So now, can you add another service? Can you add another product? Can you add a complementary service? Can you add an affiliate marketing to it? Like what is your client base buying? And what are some other things that they could be buying to add additional services? Like you could be in, wedding photography as an example, right? And like, okay, you're giving them the photos. Well, you could put together this really awesome books and table books and all kinds of other things and sell that as a package on the back end with, frame photos and all kinds of crazy stuff. Like how many people just want it delivered to them? People don't want to think about it. Like I know we got a dump of wedding photos for my son's wedding. My wife and I have wanted to put together a book for 2 years, 3 months now, that wedding. Actually 2 years and 2 months. We don't have the book yet. We would have paid handsomely for that book. Beautiful cocktail table book, which you can do all very easily, okay? But we got to go through and select the photos. We got to sit down and spend that time. I'm just thinking you got to get out of your brain and you got to think, how do I leverage this beautiful client base that I have that comes back, refers me, gives me repeat business? How do I incentivize them? Like, I want the frequency of sales. Like, you look at, the subscription model that's out there and you take some of the new pop-up gyms that are, functional this or, Orange Theory this. And the old model was, I'm going to charge you $100 a month for it. And they said, we're going to charge you $90 every 2 weeks. Think about that for a second. It's $180 a month, but everybody's looking at it as 100. 90. Oh, it's 90. It's not 100. And the math on that is absolutely incredible. And you're on a renew. And here's the gym membership. How many people belong to a gym and never show up? Cameraman raising his hand. I'm 28 days per month, okay, at this moment. So I want you to explode. I want you to think about this and say, I don't have to sell a single additional client. I have to retain and just increase the frequency or increase my pricing slightly. That drives more valuation to the bottom line. Now, when you dive into your cost of goods, and there's $6 million of cost of goods in my big company concept. Do I have somebody on my team that's managing that $6 million? Like, who's the person in charge of the $6 million? What kind of terms do I get? What kind of volume discounts am I receiving? How much inventory am I buying in advance that I'm stockpiling and paying for storage? And I need more space, right? This becomes macro. This becomes big picture. But let's just say, and I've seen this happen, the cost of goods that I'm paying, I don't have the best terms and I don't have the right discounts. When I say terms, like I may bill my customers in 90 days, but my people are billing me in 30 days. So I'm money out, waiting for money. That creates like a lot of pressure. Can I somehow bring those two elements back and cut the finance costs? Because even if it's my own money that I'm using, I have opportunity cost on that money, okay? But let's just say for a second, I could drop this by 3%, my cost of goods. It's $5,820,000, right? So that's $180,000. $180,000 goes to the bottom line. There's no other expense on that. So now I raised my prices by 5, dropped it by 3. It's geometric. When it's geometric, you get exponential growth. And there's so many things that you could be doing in your layers of cost of goods. Now, I'm a business owner. I own 1120S, big company here, and I'm paying myself $600,000. Why? What am I missing when I do that? First of all, on everything over 170, 180,000 range, I forget what it is for 25, that's going to come up, but FICA caps out at 160 to 180,000, and then you're paying Medicare. Well, Medicare on the salary, I get 1.52 deducted from my pay, and my company pays 1.52. That's 3%, a little bit rounded up, right? Just call it 3. So I'm paying myself $400,000 of additional compensation above the FICA limits. 4 times 3 is $12,000. That's simple math. I can do that. I'm paying $12,000 in unnecessary Medicare taxes that I do not have to pay. Now, there is a thing called reasonable compensation in your industry. To run the CEO of that company, you need to have some sort of reasonable compensation. So it's somewhere between $200,000-300,000, but who knows what it is? But it's sure as heck not $600,000. So that $12,000 ripple effect is money that I could be paying my kid who comes in and helps me on the weekends, $12,000 tax-free. I have 4 kids. I can pay them all that. That's tax-free on a kid that's under 18, give or take. That, but also that $300,000 that I was paying, let's say 37% tax on, plus New Jersey or whatever state I live in, that's $300,000 that I'm not getting the benefit of qualified business income deduction. What are you talking about? Well, I moved the $300,000 down to the $2.3 million. So my profit goes from $2 million to $2.3. Remember, we got the $2 million of profit. Well, if I don't pay it in salary, the $300,000 falls. The $12,000 that we were going to take out of FICA and Medicare is falling. But now I get the benefit of qualified business deduction, 199A. On the $300,000, I get a 20% deduction. I'm paying tax on $240,000. I just basically took $60,000 and I'm not paying tax on round up to 40%. It's $24,000. It's $50,000 between these two pieces. It's $40,000 of money that I'm just flushing down the toilet. And that 40 is money that I could be, oh my God, I could join a country club. I could buy a new car. I could buy clothes. I could buy my wife a beautiful, beautiful thing that's just going to somebody else that doesn't deserve it. WTF. Now, when I look at that person in that salary, right, and I'm going to line 8, salaries and wages, I got the cost of goods person up top, the person who's in charge of buying shit for the firm. fulfilling stuff. Do I incentivize them to not to cost cut, because like cost cutting, but be cost conscious? Can I get the best deal? Make it a game. Make it a game. Give them training. Invest in their training. And if that person is in charge of that, and I say to them, you're getting paid, let's say $70,000 per year. If you save cost of goods, if you can demonstrate that we've saved 3, 4, 5, 6% on our cost of goods, we've saved $200,000, I'll give you 10% of that. That's $20K. How important is that $20K to the individual that you're investing in? They're going to love you. They're never going to leave. And now what are they going to do? As you grow and you scale, they're going to be even better at this. And they're going to say, hey, John, I need more tools. I need better visibility into my books. They become a business owner with you. I'm looking at this thing and I'm trying to come back to each little move that I make is going to drive this valuation of the big company up. All right. It's going to make me more profitable. I'm going to put more money. I'm going to be able to put more money away. I'm going to be able to save more money. I'm going to have more lifestyle. What if I took that $40,000 and I said, I'm going to apply it to additional mortgage and buy a bigger house personally, get the mortgage interest deduction, buy an asset, buy $1 million asset, buy an office building. Now you see here, I got $420,000 of rent, warehouse space, whatever it is. It's massive. A couple years ago, we were working with a client who had warehouse, owned one, and had a rental on the one next door. And they had an option to buy. And basically, let's just say you're renting 100%, $420,000. 15 years from now, when you sell the business or retire or leave or whatever it is, how much of that $7 or $8 million that you paid in rent is in your pocket? There was a movie, Other People's Money, right? OPM, as it's called, right? They love you. They freaking love you. So what if I said, I'm going to take the $420,000 and I'm going to go buy my own building. I'm going to take an option on that building next door. I'm going to buy that property and I'm going to pay myself rent. And at the end of the 15-year time frame, the dirt that I'm on is worth more than the money that I paid to the landlord. I become the landlord. And as a landlord, I'm a complete jackass. I'm a mean SOB. I charge everything to the business. It's a triple net lease. You know, we want this thing to be super profitable, right? But you now have the opportunity, you get accelerated depreciation. So you can increase your rents and move it out and pay even less taxes. And all these things are add backs when you go to sell the business, right? They're add backs. Because yeah, I own my building. I pay myself market rent at the highest level, not market rent at the lowest level. Every time I pay market rent at the lowest level, I'm screwing myself. Why do I screw myself? Ask yourself that question. Are you doing that to yourself? I don't want to have to deal with the building. There's a whole, there's insurance costs. Well, it's all in the 420 because the guy you're renting from, and if it's triple net that you're renting from, you're dealing with it all now anyway. And you can't control how your building looks. I remember I had this beautiful rental space and like everybody comes up to the office and like, oh my God, some of our best clients. I'm like, I'm having trouble referring you because you pull in the parking lot and the building looks like shit. You get up here, it looks fantastic. Your space is great. Like, what are you going to do? I'm like, oh, I didn't even realize that. I think my space looks great. So I buy my own office building. I'm on a main highway, not a main highway, but a main thoroughfare into downtown. The amount of drive-by business that we've received in the last 13 years or 10 years since I bought that thing, 11 years, is absolutely incredible. But even if I didn't have that, the dirt that the building occupies and all that rent that I've paid myself and all that benefit of depreciation and the amortization of the mortgages and the pay downs and the whole thing is another asset that I have at the end of the time frame. And if I buy a $6 million property and it doesn't appreciate and I just amortize the debt down and I walk out with $4 million net because there's still $2 million when I sell it, that's $4 million that I just recaptured that I would not have had. Last I checked, that's a lot of money. I want you to realize I am giving you 100% here. Like there is no holds bar. I want you to think the way I'm thinking. I went to Bentley College, which is now Bentley University, and I had this economics class, and the guy's name was Marshall Gennaro. And I was not a really good multiple guess taker test, like not good at that. I would tutor my girlfriend. She'd get a 4.0 on the test, and I get a 2.0 or 2.7. Like I just don't see those things. I'm, undiagnosed ADD. I don't know what it is, right? I walk into this class, and he's like, think with me and tell me what you know. There was not a single multiple guess on the thing. 4.0. First 4.0 I ever got in college. I was like, oh my God, like my brain exploded because you start to think about everything is a ripple. I make one move, 2% increase, 3% decrease. I change the way I get paid. I change this. I buy a building. All of these are not linear in their outcome, right? They're exponential because it drives the valuation. Like your business might be significantly more valuable to sell it with the location than it is without the location. You might be able to sell your business and rent back, and the person's renting back from you and they'll buy the building separately. Win, 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 win. All right? You sell a dental practice and they're renting, they can move that practice anywhere. You have no value. You sell the rental property, you own the building, you got 2 sales potentially when you're ready. You could keep the building for 5-6 years and now they want to buy it, which we've seen happen. It's absolutely incredible what you can do. So now, like even depreciation, I'm showing $100,000 here on that depreciation. And I see this happen all the time. People go out and say, oh, I'm not going to use the business to buy my cars and to do my thing. I'm going to just buy it outside. Why? Like you can buy a 6,000 pound vehicle. Last year, you could write off 100% of that with accelerated depreciation. This year, I believe it's 80%. Next year, I think it's lower. Okay. Who knows? Got an election. This is probably airing post-election. So who the hell knows what happened? Okay. So my point is like, we are sitting here and saying, I can benefit. I can go buy that dream, Lamborghini SUV, excessive vehicle. I could buy the Porsche Cayenne. I could buy a BMW X5. I can buy all these wonderful cars that I'm like, so thing. And I could pay cash for it, like Dave Ramsey wants you to do. Or you can get really good financing at like certain manufacturers have really good deals because they're not selling cars the way they were 6 months ago and 8 months ago. You might get a 2% financing. So you say, I'm going to spend $100,000 and I'm going to spread that loan out over 5 years at 2%. I'm going to keep my capital because I'm going to do other things with my capital that are going to make more money in the business, which we'll talk about later. But now I get an $80,000 deduction. What's that worth? $80,000 of deduction, 40%, $32,000. So the car's not 100, it's really 70, 68. You can lease cars. You can play with your depreciation. Most leases have a 65 to 70% residual. But let's say you got a dream and you want this fabulous car. What if you said, I really want to buy this car. This car is meaningful to me, but I want to use my balance sheet. I want to use my P&L to buy this vehicle, assuming you're allowed to do the deductions. And you buy this beautiful sports car, and instead of having 70% residual value, so let's just say it's a $100,000 car. I'm leasing the car, and at the end of the 36 or 39 months, it's 70% residual, which means if I want the car, I'm buying it for 70%, $70,000. So I'm financing $30,000. That's how a lease works, right? I could do that on equipment. I could do this on all kinds of fabulous stuff for my business. But I really want this car. So I dialed the depreciation down to 30%. So now I'm financing 70. I'm getting a lease deduction for the payment, pre-tax, maybe for 65%, maybe for 66%, maybe for 50%. You got to work with your accountant on this. It's different for each business. But at the end of the time frame, the buyout of the car is $30,000. But I took $70,000 and paid for it with pre-tax dollars. $70,000 with interest is still saving me 30, 40%, $28,000, $29,000 of tax savings. I don't know if you can do this. It's ideas. I've seen it happen. Now, at the end of the time frame, I buy the car out for $30,000. What's that car worth? If it's a nice car, it could be worth $100K still. And I paid for it with pre-tax dollars. And maybe I don't want the car anymore, but it's worth $100K. I bought it for $30. I flip it. Boom, I do it. Like what could I benefit from depreciation? I've seen, trucking companies where they're leasing their trucks from a third party. They're getting a lease payment. But I've seen trucking companies create their own leasing company and they buy the trucks and they lease it back to the main business. And they get all that depreciation in another company, which offsets the other company. And they don't pay any taxes. How's your brain? My brain is just getting warmed up. Okay. Now I see this. I'm just going through this. Pension and profit sharing plans. I see 200,000 on this. What is it that you're doing and how much of that compensation are you actually getting in your pocket? I've seen business owners, we're going to put 200,000 into the plan because we want to get our deduction, our contribution for 40K. And I'm like, that's why you're doing this? Not for employee retention, not for those things. No, the employees don't even value it. You've heard that, right? Some of them do, some of them don't. But it's like, if you're going to put 200,000 out and you only get 40K, and that 40K is deferred into a tax deferred vehicle, which when I take it out, I pay tax again. I pay tax first time. I'm only getting 20K after tax, right? Well, if you're not getting any value from your employee benefit plan and you tweak it and you get that down to $50,000, you save 150, you get to keep the 150 net after tax. You can buy a bigger building, get a better deduction. Now, if I buy the building with the 420 and the 100,000 from the pension plan, I'm buying a bigger building. I'm pushing that out as rent, and then there's income coming out of that building. This is so much fun. Employee benefit programs, 1.2 million. Health insurance, all kinds of things. There's things that you could do there, okay? Then there's that other deductions, and I have $560,000. What are those things? What benefit am I getting from them? And how do I get this to basically take this to the next level, right? My goal in this conversation is to get you thinking strategically in how you make your business more profitable, how you pull more money out of the business, stockpile it. So when you go to sell your company, you get maximum value. If you get maximum value and you've accumulated more money, you're bulletproof. The next one that you need to go back and look at is, how do you own that company? Where is it? Is it in your estate or out of your estate? That's a whole other conversation. This was a shitload of fun. I hope you got some value out of this. If you did, share it, like it, sign up for a Wealth Curve conversation, expand your horizons. The Wealth Curve conversation on our website, Smallwood Wealth. This is the advertisement here for a second. You get with one of our qualified advisors, you have an introductory conversation, no fee, no obligation, nothing. And we determine what is the best fit for you. Is this something that you're going to benefit from? Don't know until we're on the phone. Love you guys. Thank you. Keep on sharing us and keep on making us awesome. Appreciate it so much. Thank you.